I remember at the peak, Facebook and Google were probably acquiring 1 to 2 startups per week, which were teams of, call it, 5 to 20 people. And remember, they were willing to pay approximately $1 million per engineer. If you remember those days, and maybe it was a little more for some teams. It ended up being $2 or $3 million per engineer. But that was kind of the rule of thumb. Now it's $100 million. It seems like for top engineer. $100 million. So for top researcher in the AI space. So it's very similar. What's going on in terms of how these large enterprises are behaving. I think the dollars have changed. I think the dollars at stake have changed too. I think AI will lead to trillion-dollar opportunities, which is silly when we think about it, but that's how big these markets are. Trillions is not an unreasonable number.
This is the OnePoint podcast, and I'm Rohit Yadav. Welcome to this new streamlined format, which is shorter, sharper, and more impactful. In each edition, I'll spotlight either an insightful trend from the ecosystem or a thought-provoking perspective from a venture expert, or a bold idea worth exploring further. And today I have Villi Iltchev with me, whose post on the Blitzhire Acquisition made quite some noise, and for a good reason. Villi is a founder and managing partner of Category Ventures. He has spent 2 decades in senior operational and investing roles, including at firms like Two Sigma Ventures, August Capital, Box, and LifeLock. So, Villi, glad you joined in.
Thanks for having me.
Let's dive right into it. So, what is Category Ventures?
Category Ventures is an early stage enterprise software-focused venture capital firm. We're investing out of our first $160 million fund, focusing on pre-seed and seed B2B software companies, which gives us quite a bit of flexibility around check sizes. We can write checks as small as $1.5 million into small pre-seed rounds, but we can also write larger checks of $5, even $6 million into larger seed rounds. The thesis of the fund was we wanted to meet where founders are and be able to invest the right amount into a startup as opposed to have our fund size dictate what is the appropriate check size for this founder. We focus on dev tools, infrastructure, and applications, kind of agents and AI, anything in between.
Okay. And tell us more about the background of starting Category, because you have been a VC before, you have been in the ecosystem investing for some time. Why did you start Category?
I mean, the reason I started Category was I saw a clear opportunity in the ecosystem and a gap to build an early stage B2B focused venture capital firm. My impression of the ecosystem was that seed and pre-seed is really, really noisy, fragmented. It's highly competitive too, but very fragmented, but also in many ways subscale. If you set aside the hundreds of firms that have 30, 50, $80 million fund sizes, who are by definition subscale, they're not able to write checks larger than say 1.5. They're almost by definition in the business of using their network, their experience, insight, relationships to get in the middle of something interesting. Even the larger funds, my impression was operate in a subscale way in the business of writing $2 to $3 million checks. But some of the rounds today are larger. They're $5, $6, $7, $8 million seed rounds. And so if you're a founder raising that type of round, you either have to cobble together a syndicate of these smaller firms, which is time consuming. It requires a lot of alignment. The alternative is going to the multi-stage firms, which I think are just a very bad product at seed. but a lot easier to raise a seed round. They can write a $4 or $5 million check, but just a really bad product. Raising, $4 million check from one of those large firms is the equivalent of me writing a 100K check. It just doesn't matter. You're probably dealing with a junior partner who may or may not have any experience, may or may not be around in a couple of years to support you. If you're dealing with a senior partner, they're on 15 boards, let's be honest. They're busy, they're buying an option on your company. And so I just don't think those firms are a good product at seed. They're great firms, but just at seed, I think founders have a different need. And so I kind of looked around and I didn't see anybody really trying to fill this space, focusing on enterprise software only, and having this larger fund size that has flexibility. So that's what I wanted to build.
Awesome. I actually loved the idea that you explained about subscale VC, right? Because right now there's a lot of discussion around either they are mega funds or they are really small funds or specialist funds or emerging funds, even talk about, let's say, solo GPs and so on. So industry is trying to force this notion of a barbell approach. Either you're on one side or on the other side. But I would say category isn't a niche fund in the sense that you're focused on few ideas and few areas. However, it's bigger size, so it's not subscale. Super interesting idea.
Yeah, I mean, listen, I want category to be able to lead any type of early stage round, pre-series A. Pre-seed, seed, it doesn't matter. Those to me are the same thing, actually. And so we want founders to come to category because they know we can lead their round. If we commit, the round will happen. You can bring others into the round. We can be collaborative and flexible, but your round is getting done. At most other early stage, those subscale firms, you need to go collect a lot of checks for that round to happen. So I wanted people to know that we are focused in that we only do seed and pre-seed, but we can lead any type of seed round.
Sounds interesting. So talk us through your emotional side of things, because the whole ecosystem has moved around a lot of waves recently. So what has your emotional experience been running category?
I mean, there's the running category, which is different than the investing side. I think they're two kind of separate things. I'm a founder too. Category didn't exist a year ago, and you're starting a business. And with that comes a lot of responsibility and pressure, right? You've raised capital from institutions that trust you, that believe you're going to be responsible and make good decisions and build a firm. And so, that weight and responsibility is there. You can't ignore it. Especially when I was just getting started, I really felt that weight on my shoulders. So you have that, and the responsibility and pressure to put together a great team, like make sure that the brand and the reputation of the firm matures, the company building side, and then there's the investing side, what's happening in the ecosystem. And I mean, it's a fairly frothy market right now, especially in and around anything that is AI. You're seeing a lot of behavior that is indicative of exuberance on the AI side. And so people are just throwing a lot of capital around behind ideas that may not have been fully thought through. So it's not an easy environment to be investing in. On the flip side, anything that is not AI actually, I think, is largely ignored at the moment, which is both an opportunity and a challenge. An opportunity because there are interesting startups you can invest in that are reasonably priced and good opportunities. That are not in the AI space. The challenge is, again, when it comes time for the Series A or B round, like if the rest of the industry is chasing only AI, then capital becomes a risk later on. So it's a tough market to navigate around right now. And so we're just trying to stay focused and make good decisions, not too caught up in chasing hype, and just focus on connecting with great people wanting to build real businesses and be disciplined.
Okay, got it. So let's focus now on the core of a sport podcast, which is the Blitzhire article that you wrote around the acquisitions, M&As, which are happening in the startup space. So if you could first clarify this concept and terminology, because this is new, this is what you introduced in the article. What is Blitzhire acquisition?
Yeah, I mean, the genesis of the article was in my prior life, before I became a VC 10 years ago, I used to lead strategy at different enterprise software companies. You mentioned a couple of them. I also worked at Salesforce and HP. And when you're doing strategy, obviously you're focused on long term, which inevitably leads to some inorganic conversations and strategy. So I ended up actually in my prior life acquiring a lot of companies. So I had some background here. And as these deals were happening, everybody was kind of, I noticed, confused and not really understanding both how they work, the rationale behind them. And so I thought, like, as the Windsurf deal was happening, there was so much conversation and confusion around what's going on. I thought I would try to put some color on why are these deals happening, how are they structured, what's driving them, and how do we make sense out of what's happening? Not that we can fully make sense out of it, because it is a bit crazy and irrational when you think about it. Uh, but from the buyer perspective, there is rationale there. These companies are not dumb. They're pretty thoughtful. So I wanted to provide some color on it. Um, and they're different, right? Typically, when acquirers want to buy a company, whether it is just for the team or for the product or for the business, there are two ways of doing it. You either buy the company's stock and then the acquired company becomes a subsidiary of the acquirer. That's kind of the most common way of buying a company. Just the shareholders sell their stock and you own now the company. You can consolidate over time. That's legal details that are irrelevant from an operational perspective. The alternative is, and this is often done for tax reasons or for liability reasons, if you want to avoid some liabilities associated with the target, you can just buy the assets of the company, the assets being basically all of the IP and contracts of the company. Then you just make employment offers to all the employees. And so you acquire the IP, you acquire the employees, and then the money goes into the company and then the company is liquidated and the money goes to the shareholders. The new structure that we're seeing is actually very different. By the way, acquihires were done in the same way. Acquihires were basically asset sales most often, where you're just going to buy the IP of the company, you're going to extend employment offers to the employees, and then the remaining company is basically liquidated after that. Maybe something goes to the shareholders, maybe there's nothing left behind, but that's how they were done. These new types of acquisitions, they're different. They're driven by desire to avoid any sort of regulatory scrutiny. So buyers are going through these very elaborate and complicated structures to avoid regulatory scrutiny. And basically, the way they work is a lot of pieces to fit together. You're at the end of the day acquiring the company, but you're pretending like you're not acquiring the company, right? To make sure that you kind of pass the regulatory HSR antitrust scrutiny. And so obviously you need to make the shareholders happy. And so cash needs to go from the stock, but mostly cash. Recently, cash needs to go into the company. So the way that's typically done is in the form of a non-exclusive license for the company's IP. the non-exclusive part is important because if it is exclusive and you're buying the IP of the company, well, a regulator can come and say, you actually acquired the company. If you acquire the IP of the company, what's the business of the company now? They don't have a business. So you kind of have to do it in a non-exclusive way. So cash goes, think like Windsurf. So Google paid like $2 billion for the non-exclusive license of the company. So money goes into the company now, and that's for the shareholders. But now the second piece is you got to deal with the people you're actually trying to hire, the people you are really after, the founders and the key engineers that you're trying to hire. And you got to pay them, something to make them go through this. And you're trying to back solve into, if we were acquiring the company for, say, $3 billion, what would the founders and the team have made? And how can we incentivize them to support this acquisition?
Got it.
And so it turns out you need to pay them another kind of $1 billion or so in the form of, employment offers for them to join you. So the second piece is you extend offers to these employees, you give them very generous, massive RSU or stock grants that may or may not have vesting associated with it. And the final piece is now you got to make the remaining business appear viable, which is to say, if everybody left behind, the remaining employees that are still part of Windsurf, don't have the cash, the runway to continue to run the business, and are not properly incentivized, and they all leave and the business falls apart the next day, then a regulator can come back and say, that was just a sham. You actually acquired the company. Look, there's nothing left behind. It all fell apart within a few months of you acquiring the IP and the key employees. So it was really an acquisition. So you need to make sure that the remaining company has enough of a runway to continue to operate the business, which is why they were going to leave $100 million on the balance sheet for Windsurf to continue to operate. And you need to make sure that there's some money left behind to incentivize the employees to stick around and go through it, give it a go. Maybe they do have a shot to continue to make Windsurf successful. But you need to incentivize them. And so that's the last piece of the puzzle, whereas you need to leave enough money behind for them to operate the company and for the employees to be incentivized. So that's how they're structured. It's highly inefficient. It makes no sense. No reasonable person would ever do all of this complexity and dance if it wasn't for concerns over HSR, and you have concerns over HSR review, but equally importantly, those reviews tend to take months, sometimes even longer than a year, oftentimes longer than a year. And if you kind of Google and you're trying to make progress, fight this AI war that you're in right now, you don't have the luxury of sitting around for a year and providing information to regulators to justify this acquisition. You want to make it happen so that those people have badges in your office next week and access to your office and can work for you the next week. And so the core reason to do this is probably avoiding HSR, but a really big and important consideration is you also achieve speed with that structure. Highly inefficient, huge leakage in taxes, grossly inefficient. Hundreds of millions of dollars ended up getting paid unnecessarily in taxes. But,
Got it.
it achieves the buyer's objectives.
Got it. Thanks a lot for taking the time to explain to us the mechanics of such deals, taking the example of Windsurf, and obviously talking about also the risks and the reasons and rationales why it's done. So we covered quite a bit of stretch. I want to move to the next part and ask about the strategic angle to it. So, in this AI race, where probably the speed is much more important, and you said such deals can be done at speed. Do you think more such Blitzhire deals happening in the near future?
I mean, do I think we're going to see a few more deals happening? Potentially. Do I think that is uh going? Do I think this structure will be widely deployed? No, I don't think so. As I said, it is grossly inefficient. It doesn't make sense. Um, and I also think that the whole idea of paying, you know, hundreds of millions of dollars, in this case, billions, to get a hold of a few key researchers and engineers. I just don't think that happens very often. I don't think it will happen very often going forward. It's not rational behavior. It doesn't make financial sense. It only makes sense kind of in the context of like these 4 to 5 companies who are in a dogfight war, fighting for like being the leader in the foundational model space. We have seen it in the past in the 2000 and kind of 12 to 14 timeframe, or 11 to 14, when Facebook and Google were in this like race to win the mobile war. As mobile was rising, we saw similar behavior where they were acquiring almost a company a week, acquihiring a company a week to acquire the talent of those teams to strengthen and beef up their mobile teams. And so those teams happen. They only make sense to those 3 to 5 companies as they're in the war. But that will taper. That will go away. I don't know if it's going to go away in a month or in 2 or 3 years. I have no idea. But it's only rational in that context. And so I don't anticipate we're going to see too many of these types of deals going forward.
Got it. So, from your perspective, not too many. We just don't know for how long, but eventually, kind of, they would cut down in terms of numbers, and it only makes sense for the top, I don't know, 4 to 5, those big players in the market to do such kind of
Yeah,
deals if they want to do it, right?
the big foundation labs that are playing a very different game. For them, it is trillions of dollars at stake. And so a few small $1 billion seem like a small price to pay in this context. But that only makes sense to those 3 to 5 players. For the rest of the universe, and it's only temporary too. I just don't think we're gonna see too many of these going forward.
Okay. And you mentioned about the previous era of mobile where there were a lot of acquisitions, but when you referred to them, they were not Blitzhire, they were actually acquihires, right? So,
There were acquihires, that's right. Typically, I remember at the peak, Facebook and Google were probably acquiring 1 to 2 startups per week, which were teams of, call it, 5 to 20 people. And remember, they were willing to pay approximately $1 million per engineer, if you remember those days. And maybe it was a little more for some teams. It ended up being $2 or $3 million per engineer. But that was kind of the rule of thumb. It's like, they're happy to pay $1 million for a top engineer. Now it's $100 million, it seems like, for top engineer. Yeah, 100 million. So for top researcher in the AI space. So it's very similar what's going on in terms of how these large enterprises are behaving. I think the dollars have changed. I think the dollars at stake have changed too. I think AI will lead to $1 trillion opportunities, which is silly when we think about it, but that's how big these markets are. Trillions is not an unreasonable number. So
So if we, let's say, move out of this AI bubble, which is trillions and billions, right? If you talk about the normal, so to say, markets of M&A and startups, IPOs are restricted right now. I mean, they're happening to some degree, but I would still say they are far away from the peak of IPOs, right? So M&As are becoming the major source for exits. How do you see M&A market right now? Because you're sitting in the hub of the Silicon Valley and you understand the ecosystem of M&A quite well.
Yeah, I mean, first of all, I want to just clarify something you said, which is I don't think the IPO window is closed. Um, I don't think the IPO window is ever closed.
No, I said
Um,
restricted, but
or,
it's
or
okay.
even restricted, or even restricted. I think it's there. I think what people don't like is the prices that the public markets are offering. And especially if you raise capital in 21 timeframe, at several $billion, even your investors don't want you to go public because the latest round investor may lose money when you go public and much rather you continue to stay private. It is probably true that the expectation is that companies are larger when they go public these days. I'm not sure that's a good thing necessarily. Um, but anyway, I do think more companies should go public. They should go public earlier. The public markets are pretty efficient. And so I think I don't view this higher threshold, higher bar for going public as a good thing. I'd like companies to go public sooner and earlier. On the M&A side, I mean, I don't think there's much change in the M&A landscape. 10 years ago, 9 years ago to be precise, I wrote a blog post that was similar to the Blitzhire blog post. It became very popular. And in that blog post, I argued that SaaS is not going to consolidate and see active M&A activity in SaaS in the way we saw the consolidation in traditional enterprise software. And the reason for that, I argued, was acquiring SaaS companies is much more complicated and much harder to create value in doing so than traditional enterprise software, where you could fire the R&D team, cut costs, the customers won't even know. If you have a sales channel, you're selling CDs, it's easier to sell and push through your channel. In SaaS, it doesn't work that way. And so I didn't think SaaS is going to consolidate, which means a lot of venture funded private companies that are kind of staying alive, never going public, never getting acquired. And I think that has largely played out. And I think that will largely continue to play out, which is not a good thing for the venture ecosystem, not a good for investors in venture. I think SaaS will continue, or just venture-backed companies will continue to have a hard time exiting. We're not going to see a boom in. I don't believe we will. There may be some acceleration on the margin, usually at the top of the cycle, which we're in, and we didn't see it. So I think we'll continue to end up holding on to these companies, which basically means more continuation vehicles, more secondaries, more ways for managers to seek liquidity, and I don't think M&A is going to come and save us.
Okay. So when you say M&A, you don't see M&A being accelerated. You mean to say that for the larger M&A deals or for the smaller ones? Because if you look at
Both.
the
I mean, actually, even more so for the smaller ones. For the smaller ones, I think, what I have noticed in the ecosystem, and that was part of the blog post I wrote, is whether you buy a 20 or $200 million ARR company, the amount of work in terms of integration work you have to do, the risk is the same. And so what I observed back then is that these large enterprises, the SAPs, the Salesforces of the world, the large buyers, when they would much rather go buy the leader, go buy the big company, go buy something that will continue to be successful, kind of add value on the margin, but more or less let it be independent and continue to rely on the leadership team of the target to continue to execute. And I think that's largely happening. The M&A that we're seeing is happening largely on the high end. It is the smaller companies, the companies that have 10, 20, $50 million in ARR, those are the ones that are having a hard time exiting. Nobody cares. It's not worth anybody's time. And so, yeah, I think those are the companies that there are a lot of them, and exiting will continue to be a challenge.
Got it. So M&A market at the same pace, not accelerating. That's your prediction. IPO, you would want them to open up. It's mostly around pricing. That's what you mentioned. And secondaries and continuation funds to make their way into the ecosystem much more. So these are your 4 predictions, right? Did I get it
Yeah,
right? Okay,
yeah, I think that's fair.
good. So what's next for category?
I mean, what's next for category is making a lot of good investments. We opened the fund in the first week of January, so the firm has been operational for the last, call it 8 months. In January, it was just me, no office, no team, no nothing. We have come together as a team. They're now, including myself, 5 of us. We are growing the firm, growing the team, active on the investing side. And what's next for category is I'm hoping in a few years, if you ask founders for, you know, what are the top most reputable early stage firms focused on enterprise software, targeting that more technical founder profile, that the category name and brand will be in the top 5 of most people's mind and consideration. So, brands are not built overnight. Brands are built over a long period of time doing consistent work and, um, you know, uh, being there for founders, you know, uh, providing good feedback, doing the right thing. When you do a lot of small things well consistently over time, I think that's how brands are built. That's what I'm hoping the future for category holds.
Awesome. With those amazing thoughts, Willie, thank you so much for joining in. Fingers crossed. I definitely wish that you become that category leader in venture. And thanks for painting this picture, because those mechanics on Blitzhire, Acquihires, and what's happening in the M&A market and so on, these are not easy mechanics for everybody to understand. I would say even not for a lot of those VCs out there. So thanks a lot, and all the best.
Thank you very much. I enjoyed the conversation.